Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three market catalysts we're watching this hour. First up, regional bank earnings rolling in after strong results from the big money center banks. We've got the scorecard for their performance thus far. Plus, the outlook for a U.S.-China trade deal, where negotiations stand, and why an agreement could be moving even further away. And Microsoft announcing a new wave of updates, how that company plans to make AI more accessible. That's all coming up on Market Catalyst. First up, let's take a look at the markets here. We do have stocks higher, but kind of in line with what we saw in pre-market trading, with the exception of the NASDAQ, which is coming off a little bit. We've got the Dow right now up about a fifth of 1%, around 85 points. The S&P 500 up about a 0.25%, and the NASDAQ up about 0.5%. We continue to watch across asset classes as well. We've got bond yields that are continuing to be at relatively low levels, 4.04%. We did just get a Philly Fed manufacturing survey. Remember, we're not getting most economic data, but the Federal Reserve is still releasing data points, including that Philly Fed survey, Philadelphia area manufacturing activity, which contracted sharply, and that was not expected. So that's something to keep an eye on here. We also are continuing to watch what's going on in the oil markets. Just a little bit of bump in oil at this point, and this is after President Trump said that India had agreed to stop purchasing oil from Russia. India has not confirmed that, but we had seen a little bit of upside in oil prices earlier in the session. And we're taking a look under the hood here of stocks. I want to point out one move in particular, and this is one that has been getting more and more attention, the move in utilities. Now, the XLU is the ETF that tracks the utilities. It's up about 0.9% today, and it is trading at a record. Year to date, this group is up 24%. And this comes back to, you guessed it, the AI trade, and the idea that we will need more power to fuel all of this energy demand created by data centers. So that's one of the reasons that we're seeing that group better. Now, financials in recent days, of course, have been one of the outperformers. Here's the year-to-date look. Let's look at, say, the 3-day look here, as we've gotten a lot of these earnings reports. So these stocks have mostly been performing well, but coming down a little bit today in the wake of more earnings coming from more different kinds of banks. So we can find the banks here. We got the bigger banks looking at this. And we've got a mixed picture for some of the bigger banks here, but we're starting to get sort of more of the regional banks. For example, Bank of New York Mellon, whose shares are off about 0.4% after their earnings. So let's dig in a little bit more on that topic. Regional banks picking up where the big banks left off, delivering strong results in the latest quarters, topping Wall Street's estimates as the booming stock market lifted client assets. However, not all of them are going up. I just pointed out BNY Mellon, those shares are off a little bit. Schwab gaining a lot less than it was earlier, and US Bancorp up a modest 1.1%. Joining me now, Nathan Stovall, S&P Global Market Intelligence Director of Financial Institutions Research. Good to see you. So, big picture here, are we largely seeing some of the same trends play out for the regional banks as for the large banks, or are they not getting that benefit of things like trading revenue and investment banking fees in the same way that the bigger ones are?
I think yes and yes. We are seeing a lot of the same trends on the fundamental piece: steady loan growth, steady deposit growth, margin expansion in a lot of cases, with banks benefiting from the remixing of their balance sheets. The low yielding assets put on during the pandemic are rolling off and being repriced higher, and getting in some cases, funding relief. And importantly, credit trends remain benign pretty much across the board. But as you said, they're not getting as much of a boost as you see from the big increase in resurgence in investment banking and trading activity as the big money center banks that we saw earlier. But all in all, pretty positive fundamental results. You're not seeing necessarily the bump in stock prices that maybe you would think to be commensurate with broad-based EPS beats kind of across the board. And some of that is because of the run-up that we had in this group in recent months. And some of it is also the idea that, we were expected to get a lot more M&A activity from this group. And it still is expected to occur. But you had a few banks give mixed emotions on whether or not they're looking at deals or whether or not they would look at a sale in the case of First Horizon, which sold off pretty heavily yesterday. But overall, pretty strong fundamentals, pretty healthy print from the group.
And when you talk about that sort of disconnect between performance and the numbers, I'm also curious for the regional specifically what the continuation of the rate cutting cycle is going to mean for those guys.
Certainly. Well, it helps on the funding side, as I mentioned. You've seen a little bit of relief there, but that's going to be one of the things that's going to help their margins going forward. It'll also pull down their loan yields, but they're going to continue to benefit from that churn in their bond portfolios. They still have lots of low yielding bonds, and there's newly available bonds at more attractive rates. And they're holding up loan pricing pretty well. So lower funding costs likely leads to stronger margins. Lower rates also hopefully supports benign credit quality continuing into the future. We do think credit likely slips a little bit further here, but we've never been in the camp that it's anything that is really a serious worry. It's more of a headwind to earnings, and sure there'll be outliers both to the upside and downside there. But lower rates offer a little bit of relief in terms of the debt service that borrowers will feel, and that's a positive thing generally from credit. But I'll just extend a little bit on credit too, because that was definitely a big worry for investors heading into this. They were somewhat apathetic after the strong run up in the group, and you'd seen the weak prints from the jobs reports in recent months. You'd seen a little bit of concern around the consumer. You'd seen a few one-offs in terms of bankruptcies. So there was concerns about what we've seen in credit, but the regionals and the big banks have done their best to try to dispel that thus far.
And are you convinced, Nathan?
I'm convinced for now, and I remain confident that we're not seeing anything really terrifying right now. I mean, the consumer is held up better than I think people have thought. I'm not convinced that we're going to avoid a cycle. Something we talk about a lot. If you go back all the way to post-World War II, we get a recession about every 8 years. So we're a little bit due. Doesn't mean that it's going to happen anytime soon. But the idea that we can avoid a credit cycle, I don't think is possible. But these results, I think, offer some confidence that banks are maintaining discipline in their underwriting and that they're not really getting crazy over their skis. But we still do think that you'll see credit quality slip a little bit from here. So you'll see higher loss content, higher delinquencies heading into 26, but it'll ultimately be manageable. I mean, you continue to hear bank executives say that their borrowing base looks good. The consumer is holding up. Yes, it's being driven in part by wealthier individuals. And yes, you're seeing some one-offs that bear watching because those are the kind of things that pop up early in the cycle. But no one's really sounding any real alarms yet.
And I'm curious for the big money center banks, the ones that we mostly heard from earlier in the week, if in some ways this is as good as it gets, right? Because they're poised on this. Yes, they're benefiting from trading and investment banking revenue going up, but rates are about to come down, which has, as we've discussed, some pluses and minuses. What do you think that future looks like, future growth looks like?
They might have a little bit more tailwind there. We're starting to see this resurgence in investment banking activity. CEO confidence remains high. Lower rates means cheaper acquisition financing. So there should be some support there as well. They don't make as much money off a spread as their regional counterparts. The animal spirits appear to be back. The capital markets appear to be open. And the deregulation narrative is an important one that I haven't really mentioned. It has really big implications for broader M&A, certainly bank M&A activity. But the likelihood of stronger capital return, meaning both an increased repurchase activity and higher dividends, certainly is something you have to think about when you talk about the bigger banks. And you're already starting to see it. You haven't seen big shifts yet, but you're starting to see messaging from the key regulatory agencies that they're going to be a little bit easier than what we saw in the past administration and be more pro-growth, more pro-innovation. So that should offer a little bit of tailwind and further wind at the back at these large banks.
Nathan, are there individual banks that you think are especially well positioned right now that you think investors should be looking at?
We don't look as much as at individual banks, but I mean, the way I would think about it is, who has the strong balance sheet to head through the cycle right now, who has the ability to play offense, because one, there is an opportunity right now that hasn't been available for the last 4 years on the bank M&A front. You hadn't really been able to pursue larger deals for the last 4 years, and it feels like the regulatory environment is far more conducive to that, and the bank M&A market is back open. Investors and regulators are both supporting it. So who can actually play there and price pretty attractive deals, and who has a proven track record there as well. I would go back to that too, even on the organic front, because as I said, we do believe that a cycle will come at some point. And as long as I've been doing this, the banks who do the best have money when nobody else has money. So who's being prudent today? Who's not getting over their skis? Who's not worried about growing too fast? And who's more focused on profitability? And there's a lot of names, in both the money center group and the regional bank group who check that box. So I still have quite a bit of confidence in the group. It just has had a bit of a strong run, and the generalist community is getting a little bit worried about, again, where we are in the cycle and could you see a turn in credit.
Nathan, thank you so much for your perspective. I appreciate it.
Thanks for having me.
Let's switch gears to airlines now. United issuing a strong outlook for the holiday season after topping earnings estimates in the third quarter. The carrier getting a boost from the growth of its premium business, but still revenue came in slightly below expectations. Joining me now, George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst. George, it's good to see you. Do I have this right that this is a yield and capacity issue perhaps that is responsible for the weakness in the shares? Can you spell out what's going on for us?
Yeah, so when you look at United's results for 3Q, they added about 7% more capacity, which is really, a lot of capacity for an economy that's growing a couple percent, right? The U.S. economy. And so what we saw is yields were falling in every market but Africa, and falling by mid-single digits. And so, those yields are synonymous with fares. And so it looks to us like the market is saturated, definitely at the sort of the basic economy level. Looks like there's just far too much capacity, and fares are pretty soft there. Now, I think some of the premium is probably softening as well. We saw that sort of in transatlantic, which I would think is, it may not be all premium seatings, but it's a higher end consumer. We saw yields falling across the Atlantic as well because of a lot of capacity, and so again, it looks like there's just too much has been added to the market here.
I mean, we've kind of seen this movie before, right? This is how the airline industry works, right? They tighten capacity, then maybe they add too much, then they have to right-size it. So do you expect United to be sort of responsive here and try to right-size that capacity? Like, how quickly is an airline able to do that?
I mean, I think they can be, fairly quick about adjusting capacity. The problem is you have a bunch of airplanes that cost a lot of money. You don't want to park them and have to bear the capital cost on them. Some of the carriers that have more owned fleet can maybe do a better job of putting down capacity. But we're already looking at 4Q. United's up in the 6 to 7% growth again in seats. So it still looks to us to be, it's just too much for this economy. Delta is up in the 3% range. Again, seems a little bit high, not as crazy as United. It looks to me actually a little bit like some of the big full service carriers are sort of keeping pressure on the marketplace now. Maybe right now they're trying to sort of push some of their competitors around, keep fares low for some of them. And so maybe that's a strategy is, try to clear some of the competitive landscape here.
In other words, are we talking about sort of a price war, or is that too strong a term to use?
Well, I mean, I think they're definitely lowering prices to fill airplanes. And again, the more, if they lower some of that back of the airplane price, so they fill out their load factors, that puts pressure on some of the low cost competitors, right? JetBlue, Spirit, Frontier. We're seeing Spirit already in bankruptcy. Would the big full service carriers like to see less competitors? I'm sure. They're profitable here, so they can, they can sort of lower fares a little bit, fill out the airplane, and keep the competitive pressure on.
So we're talking about the price part of the equation. I'm also curious about the demand side of the equation because as you talked about, the United did talk about strong premium demand, right? I think that was up 6%. Economy, I think, was up 4%. What are we seeing, not just with them, but sort of industry-wide in terms of where we are going into the holiday season and what kind of demand there's going to be?
Yeah, I mean, so we saw better premium numbers both out of United and Delta, which continues this trend. But, look, United grew capacity at, 7% or so. So if we're seeing premium stronger by 6%, it's the better, sort of part of their business right now, but it still isn't keeping pace with the amount they grew capacity. And I would assume that they grew, basic economy or, back of the bus capacity and premium capacity around the same rate, that's 7%. So is premium outperforming? Yes. Do I think premium is starting to feel some of the pressure of excess capacity? I do. So I think, fares are not softening as much there, but I think they're softening a bit.
And then how does it work in terms of how much does price feed into demand? In other words, if we're going to continue to see some of this pricing competition, does that mean that people are going to be flying more because they notice?
So, price feeds into demand, significantly, right? At a lower price point, you just get a lot more people willing to fly. One of the other things I think in the equation here is that fuel had been a tailwind for the airlines really up into 3Q. I think, a sort of teens % lower year over year kind of tailwind. That ended in 3Q. And so as we go into 4Q, I think a big part of this equation for how much fares can move and airlines can stay profitable will be where fuel comes out. It's a big portion of airlines' expenses. Right now, fuel looks to be diving even lower, could provide some room to lower fares and fill airplanes. And that would mean that, even as you're lowering fares, airlines could be close to as profitable as they were last year. When we look at the range that United gave us for EPS for 4Q, it looks to me like they're not at least in any scenario they see, going to be as profitable as they were the year prior. So we're still seeing airline earnings, and they weren't in 3Q. We're still seeing airline earnings sort of fall.
Gotcha. So oil or fuel will be one of those swing factors. George, good to see you.
Definitely.
Thank you so much.
So, thank you.
Coming up, uncertainty in Washington over President Trump's oil negotiations, plus why one expert thinks chances of a China trade deal, they are shrinking. As the U.S. government shutdown stretches into its 16th day, chances of it being resolved before the end of the month seem slim after a 9th failed vote in the Senate on a funding bill Wednesday. Here with more, Yahoo Finance Washington correspondent Ben Worschel. Ben, there doesn't seem to be a lot of motivation at this point.
For sure, yeah. So we're 9 failed votes in the Senate so far. We're set for another vote in about an hour's time at 11 a.m. That's expected to have the same result, and then after a few more votes, the Senate is set to head home for the weekend. So there's no kind of end in sight immediately on this shutdown. One tentative signal on talks that's worth tracking is Senate Majority Leader John Thune did reveal this morning that he's offered Democrats a date certain vote on this issue of Obamacare subsidies after the shutdown ends. That's a minor concession. It's not going to be enough for Democrats who want this to be happening all at the same time, but it is at least directionally a signal that talks could be in the offing there. Not this week, maybe next week, maybe weeks after that, but we're talking more and more about November as a timeline when the pressure on this heats up. The immediate question for the economy right now, I think, as markets largely have been ignoring this shutdown, is this question of Trump cutbacks, reductions in force, layoffs of government employees. We had a few developments there in the last 24 hours. Trump's budget chief talking about having thousands and thousands of layoffs as part of their overall goal here. Trump talking about cutting what he calls Democrat programs. We also had a ruling that paused these layoffs for now, although it's temporary. Trump is still going ahead promising that before the end of the week, he's going to announce more layoffs, more cuts to programs. Whether that can go in force remains to be seen. But this is clearly going to be kind of the standoff is going to continue for at least a few more days, if not more weeks.
Feels that way. Ben, let's shift gears to foreign policy. President Trump also claiming yesterday that Indian Prime Minister Modi says that his country is going to stop importing Russian oil. Listen to him.
He's assured me there will be no oil purchased from Russia. I don't know, maybe that's a breaking story. Can I say that? Would you say? There will be no oil. He's not buying his oil from Russia. It's started. You can't do it immediately. It's a little bit of a process, but the process is going to be over with soon.
Ben, I don't believe India itself has confirmed this yet. So what do we know about this?
Correct. We don't know a lot about this beyond this claim from Trump. I mean, this comes ahead of a highly anticipated meeting tomorrow in the Oval Office between President Trump and Ukrainian President Vladimir Zelensky, and a possible call between Trump and Vladimir Putin on this issue of the war in Ukraine. And this would be a major development in terms of pressuring Putin to end the war because of his reliance on Indian oil purchases. As you mentioned, what we don't have is confirmation. We don't even have confirmation that a call occurred between Trump and Narendra Modi of India in the last few days. The Indian Foreign Ministry had some comments this morning about diversifying energy sources, talked about increased energy cooperation in the United States, but notably did not confirm or deny any plans to go to zero Russian oil purchases. There is some evidence that Indian traders are looking to cut back. There's a Reuters report from New Delhi this morning about Indian traders lessening their purchases of Russian oil, but notably not at the behest of the Indian government. So even a small decline, even if it's not what Trump is promising of zeroing out and happening soon, would be significant as it would cut into Putin's efforts. I think the larger context way to understand this is tariffs. Indian officials are also reportedly in Washington this week to talk about tariffs. There's a 25% tariff on India over this issue of purchases of Russian oil. So I think there's a calculation happening here that maybe some declines of Russian oil purchases could lead to some declines of tariffs at that 25% tariff. Whether that works out, how much it goes down in each direction, very much clearly up in the air.
Ben, thanks for keeping track of it all for us, as always. Thank you. Treasury Secretary Scott Bessent saying Wednesday that there is a possibility of extending the tariff truce between the U.S. and China. The deadline before sweeping tariffs of over 100% additional go into effect is November 10th. While President Trump and Chinese President Xi are set to meet later this month, my next guest says a comprehensive trade deal nowhere in sight. I want to bring in Shehzad Qazi, China Beige Book International Managing Director. Shehzad, good to see you as always.
Good to see you.
So certainly it doesn't feel like, it feels like the two sides are getting further apart with this latest surge in rhetoric. Bessent, in a press conference the other day, really coming out with some pretty strong words for the Chinese. What's going on here? What happened?
What happened over here fundamentally is, first of all, there was no real phase two process, even though there was a lot of optimism building in recent weeks. There's absolutely no march towards that deal that was taking place. Then, of course, you have commerce coming in and refining export control rules by putting in that 50% ownership rule, I guess I should say, and that really caught the Chinese by surprise. They were legitimately upset by that, and they respond, of course, very aggressively with their rare earths.
Remind me which export control rule this was, because it's hard to keep track of with the back and forth.
So fundamentally what this says is that if you are a Chinese entity that is not supposed to be receiving US-made chips, and you have a 50% ownership in another entity, that entity would also be blocked, right? So this was further fine-tuning and making sure that the export controls on the books actually make sense and are implemented in a sensible format. The Chinese saw this as a new action against them and were just incensed.
Now, the playbook that we have become accustomed to, the markets have been accustomed to, is both sides kind of go at each other. Usually the U.S. has been the aggressor, so to speak, with President Trump coming in with these dramatic pronouncements. Both sides sort of ratchet it up, and then you get that de-escalation. Are we still there? Is that, knowing what you do about the Chinese economy and how China operates, are we going to see that de-escalation this time?
I don't question that a de-escalation isn't possible. I think it's quite likely that, especially in the lead up to APEC, that you see both sides letting things cool off. But I think what we are from a longer term perspective over the next several years, I think we might just see a repeat of this over and over again, because either you just cannot bridge the gap between the two sides, which is what I firmly believe, and at the same time, you also don't have sort of this conversation taking place that we're going to decouple here and we're going to try to work together with each other here. So you're left with this mess that markets are constantly suffering as a result of.
Why don't you think we'll be able to bridge the gap? Because we both are, as you say, we're still not decoupled. We're pretty reliant on each other economically. And at least in theory, we should both be prospering together. It's in everyone's best interest for us to work together.
Well, I think the big problem is that from the Chinese perspective, that we finally come to a decision that says that we cannot just hand over all our latest technology to China. That's something they don't like. On the other hand, of course, we'd like China to rebalance its economy and not artificially keep prices low and dump its products abroad, which is not just a U.S. problem, but a global problem. And China will tell you all day long that they intend to not do so, but certainly that's been their economic model and continues to stay. I think those just right there are two of the biggest things keeping both parties in this conflict.
So what are the implications of all of this? So let's talk about the Chinese economy first. That's where you focus your attention. We did talk to a Wall Street veteran the other day who likes the Chinese market and who says, they're willing to put stimulus in no matter what happens with U.S. trade talks, and the economy's on solid footing. Do you agree?
The economy is actually doing much better than the perception has been. The summer slowdown narrative, I think, is rather misplaced. If anything, we've seen the Chinese economy post a recovery over the second quarter, into the third quarter, into the summer. Now, we'll see if that carries on into Q4, but certainly, parts looked stronger than what the market narrative had been.
And so what does that imply also for negotiations then?
I think it implies that you're looking at a Xi Jinping, you're looking at Beijing that are not panicking.
And so does that mean, between the U.S. and China that I guess I'm just still trying to figure out how all of this plays out.
Yeah, I think, what you get is these series of mini truces taking place. I could even see the two sides working towards a very narrow phase 2 agreement. I think if the Chinese come to the table tomorrow and make pledges to start buying soybeans and agree to perhaps purchasing some Boeing airplanes and so forth, and roll back some of their more egregious export controls that they've rolled out, or clarify that they mean it, that civilian uses will be fine, et cetera, I can see there being a phase 2, but the process to that will be, I think, incredibly messy, and I don't know how long that deal will last before the next blow up.
And in the short term, you mentioned APEC. That is the meeting, the Asian leaders meeting, where Xi and Trump had been set to meet. Then Trump said they weren't meeting. Besson says they're probably still meeting. Do they meet, and what should we be watching for at that meeting?
I think from the Chinese perspective, they're going to not want to do anything very televised, getting the two presidents together in front of cameras. So from a public standpoint, we may not hear much. Do we just get a handshake? Do we get an understanding that says let the two sides continue working on resolving some of our issues? I think the Chinese side is not going to be wanting to get in front and having to see Trump making too many comments, even though the president may actually prefer that.
Our expectations should be low, in other words.
Absolutely, expectations should be very low on this.
And then finally, picking up on what we were talking about with the president saying India has agreed to stop buying Russian oil. Do you think China goes there? Is there any chance of that?
Absolutely not. And I don't think we're even going to push them.
Okay. Shehzad, great to see you. Great to get your perspective, as always. Well, you got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. Starting with Micron. Shares getting a boost after UBS raised its price target to $245 from the prior $225, saying demand for its memory chips is stronger than expected. UBS says Micron is benefiting from the surge in AI-related demand, especially from big tech companies that need more data storage. The firm now expects earnings to climb sharply next year, with profit power potentially hitting $30 per share by 2026. UBS calls this upcycle, quote, more durable than prior ones, and says margins could reach around 65% as supply remains tight. UBS is keeping its buy rating on Micron, calling it one of the best ways to invest in the AI boom. Next up, Lululemon. Shares are slightly lower after Bernstein downgraded the stock to market perform from outperform. Analyst Anisha Sherman says sales trends in the U.S. have worsened and that hopes for a 2025 rebound are fading. She noted a short-term lift from Lulu's Amex Platinum partnership, but did say the next big product push is still 6 months away and unproven. Bernstein also cut its price target on shares to $190 from $220. The stock is now down more than 55% since the start of the year. And finally, T-Mobile, the stock moving higher after Wells Fargo upgraded shares to overweight and named it its top carrier pick. The firm highlighted T-Mobile's network strength, growing free cash flow, and steady market share gains, even as rivals like AT&T and Verizon turn more competitive.
Wells Fargo also raised its price target to $260 a share, saying it expects the company to keep leading the wireless industry in subscriber growth. The next catalyst for investors, earnings. T-Mobile slated to report results in just 1 week on October 23rd. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We are watching Snowflake and Palantir, Travelers, and JB Hunt. First up, Snowflake and Palantir are teaming up. Snowflake shares higher on news it will integrate its AI data cloud with Palantir's flagship Foundry AI platform. The companies say the goal of the partnership to deliver more efficient data platforms and faster analytics. Shares of both companies trading a bit higher. Next up, we're looking at Travelers. Shares of the property and casualty insurer falling on mixed third quarter results. Profits surpassing analyst expectations. Net premiums written, though, missed, and those shares are off 2%. And finally, JB Hunt. Shares of the logistics company soaring after it topped Wall Street's estimates in its third quarter. One Citi analyst praising JB Hunt's cost control strategy as it navigates a weakening shipping economy. Those shares up a whopping 18% in the session. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, how to play discount retail stocks. That's next on Market Catalysts.
Dollar Tree reaffirming its outlook at today's Investor Day, putting fresh focus on the value retailer trade as consumers continue hunting for bargains amid lingering inflation pressure. We're navigating how to play value shopper stocks for the Yahoo Finance playbook. And joining us now, we've got Anthony Jacumba, Managing Director at Loop Capital Markets. Anthony, great to see you, as always. You know, maybe start for big picture, Anthony, before we get to specific names, because we're always looking for a line of sight into the consumer. You have that based on your coverage universe. So I'm curious, Anthony, generally, you know, based on what you see and hear in your coverage universe, how would you characterize the consumer here? How healthy, how resilient?
The consumer is relatively healthy. I mean, unemployment is still pretty low. Wage growth is still pretty decent. Now, there are certainly ongoing concerns about inflation. It certainly has remained a little bit elevated, but I think that the fact that the Fed is cutting interest rates is certainly a good thing. So the consumer is relatively healthy. I wouldn't say they're in amazing shape, but I would say they're in good shape.
U.S.-China trade tensions back in focus, Anthony. Barbs being thrown here between Beijing and Washington. How exposed is your coverage universe to those tensions?
So to be clear, a couple things. First off, if you're talking about the remainder of this year, really not at all. I mean, folks have already bought all the inventory that they're going to sell over the holiday selling season, probably into early next year. Longer term, obviously, yeah, if you're talking about 100% tariff on Chinese goods, a lot of these companies are exposed. But the thing I will say is they're a lot less exposed than they used to be, right? Because we've seen this movie before. And so when you had the first Trump administration and these tariffs come on, a lot of companies started to diversify outside of China. So for any company that I cover, their exposure to China is significantly less now than it was, let's say, in early April, and certainly significantly less than it was during the first Trump administration.
How were those names, though, Anthony? How did you see them sort of navigating the tariff dynamic, though? Like, what moves have they been making? What levers have they been pulling?
So there's been a few different levers. One is, like I said, just trying to diversify out of China. So maybe sourcing from Vietnam or India, or maybe even near shoring to Mexico if possible. The second thing has been, and they've been very quiet about this, but they've done it nonetheless, is raising prices, right? I mean, they just, you have to remember, retail is a very low margin business. I mean, if you have a retail that has a double-digit operating margin, they're dancing in the streets. So they cannot absorb these tariffs. And so they are passing those price increases along to consumers. And then to the extent that they are, eating some portion of them, they're trying to offset that through cost cuts in other areas in the business. And the one other thing I will say is that some of it, they are kind of pushing back on suppliers as well.
Let's get to some names, Anthony, while we got you. Dollar Tree, it looks like, I know you covered that one. They made some news today. It looks like projected earnings per share, looks like rise as much as 10% annually over the next 3 years. Looks like they see fiscal 26 EPS growth by high teens percentage. What did you make of those headlines and what you heard?
So, look, I mean, At a very kind of high level, when you look at the targets that they set, 12 to 15% annual EPS growth over the next few years, they seem very impressive. The problem, from my perspective, is that they just don't have a lot of credibility right now because they've had sort of this track record of sort of over-promising and under-delivering over the last few years. So it's really going to be very much a show-me story. Now, to be clear, they did sell the Family Dollar business. They got a lot more than that for it than I think a lot of folks thought. They got $1 billion. I think they would have been happy with a bag of magic beans. But, that doesn't necessarily cure all of their ills. And they're also doing this multi-price strategy. They've seen some early success with it. I do worry that at some point maybe you lose the uniqueness of selling everything or virtually everything for $1.25, but that remains to be seen. But more than anything, they have credibility issues.
Well, let me ask you, Anthony, because I think you got holds on both Dollar Tree and Dollar General. But if I pressed you, Anthony, I said, listen, in this environment, in this backdrop with this consumer, is there one that's relatively better positioned than the other? Would you pick one?
If I had to pick one, I would probably pick Dollar General. I just think that the management team under Todd Vasos has more credibility and a better track record of actually, meeting expectations or exceeding expectations. It's interesting because, this is not his first rodeo. This is his second stint atop the company. And when he came back, he laid out this turnaround plan, and it did take longer, I think, for us to see the results than we were expecting. But they are hitting on all cylinders right now. They also are definitely benefiting from consumers trading down from more expensive supermarkets, drugstores, convenience stores. So if I had to pick one, I would definitely go with Dollar General.
Anthony, always great to see you, sir. Thank you.
A big announcement from Microsoft this morning, the tech giant integrating AI features from its Copilot chatbot into Windows 11. And tech editor Dan Howley is here with Yusuf Mehdi, Microsoft Executive Vice President and Consumer Chief Marketing Officer. Dan, take it away.
Yusuf, thank you so much for joining us. What can you give us about the news? These are obviously big updates for Windows 11. What does this kind of addition of AI kind of permeating the operating system mean for us?
Yeah, I mean, this is probably one of the biggest changes we've made to Windows, I'd say, in almost over 40 years, where the last time we had a big change, you had the mouse, and the mouse changed how you use Windows. Today, we're essentially enabling truly an AI PC for nearly 1 billion people. And what that means is really 3 things. One is now you can talk to your computer, and it will understand you and take action for you. Second thing is, big thing with AI is you have to give it context. You have to give it smart prompts. Now we have this feature called Copilot Vision, so it can see, if you choose to allow it, anything that you're doing, and then help you with that, whether it's trying to play a new game and tell you about the features of the game or tech support. And lastly, it can act on your behalf. So like you take a bunch of photos and it's got the, those crazy file names or whatever. Now you can just say, hey, Windows, just automatically automate all those photos, give them a good name for my last vacation, and put them all into portrait mode. So it's a huge thing, and all you have to do is press the Copilot key on the keyboard or say, hey, Copilot, and you can do all of these amazing things starting today.
Why is it important that, adding the vision and the voice kind of together, why is that so important? Why is that the big differentiator here?
Yeah, this is a great point. So right now with AI, you basically have 2 things happening. You have all these chatbots like ChatGPT or Copilot going up, but people have to learn a new app. They have to learn, how to go about it and type context. The second phase, I think, is when it gets naturally integrated into what you do today. So for us, that's 1.6 billion Windows users. That's almost 1 billion Microsoft 365 users. And it's the combination of simplicity and power. The simplicity of just being able to talk just like we are now and not even know exactly what I want, and then having the computer understand everything that I'm doing. That's what makes this magic happen. And so scenarios like I'm playing a game, right? We're playing Age of Empires, and I want to know which civ, for example, is best for water battles or land battles. Before I'd have to plow through the tech tree, not anymore. Thanksgiving, you're probably tech support for your family, right?
Yeah, I was just the other day.
Yeah, and now what happens with Copilot, we have a feature now where someone can talk to it and say, hey, show me how to do this. Show me how to set up a printer, or show me how to change my Spotify algorithm. And Copilot can see it, have a magic cursor, and point you to where to click to get things done. No more tech support for you, Dan, at Thanksgiving.
No more shaky hands, pointing a camera at the screen and my mom yelling at my dad in the background. I guess, what does this mean for customers and businesses then, right? Because you have the Windows 10 end life just came.
Yep.
The end of support. So everybody's moving to Windows 11 or should move to Windows 11. What does it mean for the customer side and the business side that these updates are coming?
Yeah, I mean, it's a powerful thing. Like I said, almost 1 billion people have access to it now today, just by click or say, and then a couple 100 million more are going to be buying new PCs over the next year. And what it means is that you will now get a computer that really will give you more for your money. It'll basically save you a bunch of time, help you take action on things, learn more about the world in a really simple fashion. So that's like the big change. And as you said, it's Windows 10 end of service, end of support. And so there's a lot of people out buying a new computer, and this is really the only one that does this combination of AI and then being an easy to use device.
I think it's important to point out, if you don't want to talk to it, you can type to it.
That's correct.
Just because if you're at a coffee shop and you're talking to your computer.
Yeah, you bring up a great point. People sort of say, oh, well, you really talk to computers. It's a great question. But if you think about it, today we have hundreds of millions of people who spend billions of minutes talking through their PC on Teams calls, Snapchat. What we're doing today is we're letting you not just talk through it, but talk to it, talk with it. And that is going to be, it's going to be a new thing. We're going to have to learn to do it. Just like when the mouse came out, we had to learn how to use the mouse. We're going to learn how to kind of get comfortable with voice. But I think it'll be the biggest change we've had in, like I said, like 40 years.
I hope it's better than having to learn the keyboard at first, the hunt and peck.
Yeah.
As far as the Windows end of service, do you see, I was just reading Gartner said that there was an 8.2% increase in shipments for PCs in Q3. Do you see this giving a boost to sales? Do you see it kind of working together with the Windows 10 end of service? How does that kind of work together as far as moving forward into the holiday season and sales?
Yeah, it's a great question. I think it is additive. So as you said, over the last year, we've seen an increase in PC sales, like a notable increase as people want to get the latest PC before the end of service. I think that will continue for another 6 to 9 months. We'll see, but I think that's going to continue. And now you have a new value prop, a new reason to go get a new Windows 11 PC, which is that now you can talk to it and have it take action. I think the combination of those two will continue very strong PC sales.
And I just saw Mustafa Suleyman. He's obviously the CEO of Microsoft AI. He tweeted, X'd, I don't know what you say, but basically saying that this is a step towards AI as an operating system, or AI being the operating system. Do you agree with that? Do you see that this is that kind of movement? Because when you're adding all of these different AI pieces and you're automating parts of it, it does feel like that's kind of where this is all headed.
Yeah, for sure. I mean, that's the way I think about it today. I mean, if I was to say it in sort of friendly language, this is the real life Jarvis. So if you've seen the movie Iron Man and Robert Downey Jr., right? Yeah, he walks up to his computer. Right now you walk to your computer, it just sits there, it's not doing anything. But now, with what we're announcing today, you can walk up to your computer, it'll recognize you. You can say, hey, catch me up. What have I missed? What's hot? What do I need to pay attention to? Okay, great, bring me up some more information about that, help me prepare. And then say, okay, go take some action. Like I said, go organize my photos, or go find some files that I have on OneDrive, or go book reservations for me for tickets. And that you now have essentially that Jarvis computer in real life. And again, it's just one click of the keyboard on your Copilot Plus PC, and you're able to do it.
Booking reservations would make date night a lot easier. Yusuf, thank you so much for joining us. Julie, back to you.
Thanks so much, Dan. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the 3 market catalysts we're watching this hour. First up, regional bank earnings rolling in after strong results from the big banks. We'll have the scorecard for their performance thus far. Also, we're talking about AI and what's going on here, the various headlines that we've gotten from the likes of Microsoft and Apple. And speaking of Microsoft announcing a new wave of updates, how the company plans to make AI more accessible, that's all coming up on Market Catalyst. All right, let's take a look at what's going on in the major averages at this moment. We are still seeing a rally across the board here, albeit a modest one. The Dow right now up about 86 points, the S&P 500 up about 0.4%, and the NASDAQ up about 0.2%. And let's also talk about what's going on further in AI with the developments that we've been getting from the likes of Microsoft and Apple. They're bringing AI to their devices, as we just heard from Microsoft. Apple unveiling its new M5 AI chip, which will be in its 14-inch MacBook Pro, iPad Pro, and Apple Vision Pro. Microsoft integrating AI into its Windows 11 operating system. So are these features enough to get consumers to upgrade their devices? The big question. Here to discuss, Bob O'Donnell, president of Technalysis Research. So, I mean, I know it's a case-by-case basis, but it seems like that is the overarching question behind all of this AI back and forth. Is it too much investment?
Right.
How is it all going to play out? What is the end market for all of this?
Yeah, it's
flood of stuff.
It's a great question, Julie. I mean, the bottom line is we're really at the very, very early stages of this, and that's part of the challenge. But what we saw, what Microsoft announced today in terms of bringing AI into all of Windows 11, not just the Copilot Plus PCs, with Apple integrating a little bit more AI compute with the M5. I'll talk about that in a second. All of these things are moving us towards a day when we can start to interact with all of our devices, with our PCs, with our phones and other things in a more natural human way. Some of those things are going to be subtle, right? So they're not going to have that whiz-bang, kapow sort of thing, but other things are really going to be very practical. Now, in the case of the new Apple stuff, to me, the M5 is interesting, honestly, more from a technical perspective, and as a silicon guy, watching the strategy of, they're bringing M5 now, they're bringing in their modem into the iPads. That's kind of interesting from an industry analyst perspective, from a semiconductor perspective. I'm not sure it's going to drive a ton of people. It's a nice refresh, like if you're about to buy an iPad, for the holidays, okay, great, now I can get the new one.
Right.
And so you're going to have those kinds of things. In the case of Microsoft, I mean, the nice thing that they're doing is something I think they frankly should have done before, which is bring more AI into all Windows 11 devices. And that's what they're doing here now is, they're leveraging the cloud. They're not doing all of this stuff on the device. They're leveraging the cloud, but they're enabling things like the ability for Windows to see what you're doing. So when you ask a question about something on your screen, it can actually help you out. That kind of stuff is practical.
Okay, so it's cool. Is it enough to drive an upgrade cycle?
It's not going to drive a major upgrade cycle beyond, I think, the typical cycles that we've seen. I think we're going to see, we're continuing to see interest overall in AI PCs, but at a more modest pace, frankly, than a lot of people initially expected. Because part of the problem was all this focus, without getting into too much detail, but on this notion of an NPU, this dedicated piece of the chip that was going to do AI acceleration. And in truth, it's taken a long time for software developers to create applications that leverage that NPU. And instead, of course, we've seen all this massive investment in doing things in the cloud. And so people get confused because they're like, well, if I'm running OpenAI on my PC, does that mean I'm doing, AI on the device? Well, not really, but nobody really cares. At the end of the day, It's about what can be done, right?
Yeah.
And so, we're starting to see things done. And then in the enterprise, we are starting to hear stories, right? There's companies who are deploying this stuff. I was just at a Dell event the last couple of days, had a chance to talk with Michael Dell and some of his other leadership. And, they're deploying this technology, sort of drinking their own champagne, as they say. And they see, for example, they have a chat tool for their salespeople. And they can directly see people who are using that tool are performing better than the employees who aren't. So that's a real classic example of things that are happening. There's plenty of other of those types of examples. The big question that you were hinting at earlier, I think, is, but does that justify $1 trillion in OpenAI, right? Look, let's be honest, that's a multi-year play. The market doesn't always have the patience for a multi-year play. But I will say this, their developer day last week was really interesting to me because what Sam showed during that keynote was that, this idea I think a lot of people hadn't thought about. They were integrating applications into ChatGPT. They were integrating agents. They were integrating commerce, this deal they did with Walmart. And so all of a sudden you're thinking, wow, they're actually almost creating an operating system, right? And if they're able to do this, it completely wipes out the traditional way of how we've thought about doing computing, and everything happens through ChatGPT. Now, look, that's a long stretch, but I think they're thinking big picture in terms of all of this stuff.
Great. How do they make enough money from it to justify the spend?
Well, they would have to be able to get people to buy into that big vision, and they would change the nature of the economics of, for example, applications would all become agents and they would live within there.
And the other thing is, Bob, like, why do I need that?
It's all,
that is,
I know.
And even the Dell example that you give, like, it's all a push, it's not a pull. This is what I keep saying about this whole thing. They're telling me all this stuff I need.
Yeah.
Like, and yes, I get that, yes, lots of people are signing up for ChatGPT and saying it's helping them, blah, blah, blah. But, like, it's more of a push than it is a pull at this point. And even the Dell example that you just gave, the salespeople are those the salespeople that would be better anyway?
Look, that's a fair question. But companies are starting to think differently about how they deploy these tools, and frankly, thinking about what kind of people are they going to continue to employ, right? The other challenge we're seeing is some companies are saying, hey, we're leveraging this technology, and in the process, we're able to achieve more with less people.
Right.
And that ultimately, because look, it's a great point, but that ultimately is the thought, is that we're going to see some kind of ROI where we can be more productive with less. But as we all know, look, the money is in the picks and shovels these days, right? All the guys making money in the AI area are all the ones selling the picks and shovels.
Right.
But unless the gold miners actually find the gold, at some point you stop buying picks and shovels, right? And that is, of course, the big question mark. But, can these things start to be monetized? That's the big question. What are the mechanisms by which, how does commerce, like I said, get into there? Well, Walmart saw a huge burst, even though I doubt the amount of sales they're making through ChatGPT is very high. But it's the vision that people are buying into right now. And again, as I said earlier, how willing is the market? How, patient are they to stick around to see that vision being fulfilled? Because it's got to deliver something that makes your life better, right? I've got to be more effective at work. I've got to be able to get more things done. If I'm a large-scale organization, I have to get more done with less people. Those are the metrics by which this stuff is going to be measured. And, like I said, it's still very early days, and there's not a ton of examples, a few nuggets here and there.
We'll see how it goes.
Yes.
Bob, thank you so much. Good to see you.
You too. Thanks, Julie.
Coming up, the CEO of D-Wave Quantum joins me next. The company continuing its push into Europe. Stay tuned. You're watching Market Catalyst. D-Wave Quantum continuing its push into Europe, announcing nearly $12 million commitment with Swiss quantum technology to deploy one of its quantum computers. Joining me now, Alan Barrett's D-Wave Quantum President and CEO. Alan, good to see you. Thanks for joining us.
Nice to see you, Julie. Thanks for the opportunity.
So talk to me about this latest deal agreement that you have with this Swiss company. And I know it's part of sort of a bigger push into quantum in Europe, but talk to me about how this fits into that.
Sure. So I'm actually talking to you from the Digital Innovation Forum in Lake Como, Italy, where earlier this week we signed a memorandum of understanding to become a founding member of a new entity called Q Alliance. And its mission is to bring quantum computing to Italy. Now, the agreement that we signed yesterday with Swiss Quantum Technology is all about placing a D-Wave quantum computer, an Advantage 2 quantum computer, our latest generation system, here in this region. Swiss Quantum Technology is paying 10 million euros to purchase half the capacity of the system over a 5-year period, and that will become accessible through our Leap cloud service to academic institutions, businesses, government entities here in Italy to drive quantum application development and usage.
And then talk to me about where we are in terms of the commercial applications. You and I have talked before. You've talked about some companies that use this for sort of business optimization. Where are we on that adoption curve and how it's making its way into commercial enterprise?
Well, we continue to drive work with our customers around, first, proofs of concept to help them build applications and then benchmark those to determine how much value they can create and whether or not there's a good ROI, and then working with them to move those applications into production. We have a number of customers that have now moved applications into production. I've talked about some of these in the past, like Pattison Food Group. I've talked about Ford Otosan. I've talked about NTT Docomo. We've just completed some work with North Wales Police in the UK to optimize forward placement of police vehicles and other support vehicles to be able to respond to incidents in a more timely fashion. We've done work with Japan Tobacco around molecular discovery for new drugs. So we continue to work with customers to help them build applications, to benchmark those applications, and once they determine there's a good ROI, to move them into production.
We were just showing your stock chart, Alan, and you're very familiar with it. The stock is up almost 400% this year. We have seen so much enthusiasm for quantum companies and quantum stocks like yours. We've talked a little bit about this before, and I'm wondering, are you doing anything sort of specifically and directly to court retail investors or to communicate and engage with them?
So we are working on a regular basis to help the market and the investors understand what we are doing from a technology and product perspective and the value that it can deliver into the marketplace. So over the course of this year, we've delivered our 6th generation quantum computer, our Advantage 2 quantum computer, the largest and most powerful quantum computer in the world. We've continued to move customers into production. We have demonstrated quantum supremacy on our system, the ability to solve an important real world problem that cannot be solved classically. We've increased cash on the balance sheet so that we have significant liquidity now with over $800 million in the bank. And we continue to work to communicate all those important elements of how we're building and strengthening the businesses to all investors.
So that obviously is the fundamental case. And then sometimes you get the fundamental case a little bit divorced from what people are hoping for, right? Which is, in some cases, people, it's like they're investing in a lottery ticket, right? I'm curious, you guys have obviously seen big revenue growth as you've been signing these new contracts. Do you expect at some point to see sort of this critical mass explosive growth as you gain more and more traction and adoption of the technology?
So the short answer to the question is yes. We have had a good year. In the first half of the year, we had roughly 290% year-over-year revenue growth, roughly 400% year-over-year growth in gross profit. We are continuing to add new customers. We're continuing to grow both our quantum compute as a service business, which is what customers use to run applications, as well as our system sales business, putting systems on premises. For example, we sold a system to the Jülich Supercomputing Center. We just announced the placement of a system here in the Lake Como region. We signed a memorandum of understanding for acquisition of a system in Korea. So we're driving both the application support portion of our business, quantum compute as a service, as well as system sales. And I do believe there are a few applications that will really drive what you call explosive growth. Two that I've mentioned before are blockchain and AI. In both of those areas, our quantum computers are able to support the underlying core computation much faster and with much less energy consumption. And I think that's going to be a real game changer across those two environments. For example, if Bitcoin mining today was being done on a new quantum proof of work that we developed on our quantum computer, we would be consuming 1,000 times less electricity than what's being consumed today to do mining. And we're in the process of working to bring that to AI as well.
And Alan, the other thing I wanted to catch up with you about is sort of regulation, but also initiative. In other words, the last time we talked about the U.S. approach to quantum versus, say, the Chinese approach to quantum from a government perspective in investing in the industry. Where are we at this point? And and if you could address Washington directly, what would you say that you want them to do on this front?
I think the quantum industry is still waiting to see what the U.S. government is actually going to end up doing in this arena. We've talked about this before. The National Quantum Initiative, that's the premier funding mechanism for quantum in the U.S. that was originally authorized in Trump's first administration, still has not yet been renewed. And so, we are essentially waiting for the government to get its act together and move forward with support for the quantum industry. In addition, I think it's really important for the U.S. government to start expanding how it thinks about quantum, because up until now, what it has done has been primarily focused on long-term research for just one architectural approach to quantum. As a result, it is missing other approaches to quantum, like annealing, which is something that we at D-Wave have brought to the market. And it's also missing a focus on near-term applications. Again, like what we are doing today with a broad array of customers, and what we could do to help the U.S. government as well benefit from quantum today, not many years in the future.
Alan, good to see you. Thanks for joining us.
Thank you, Julie.
We got much more markets action coming up, including a check on trending tickers. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Allie Cannell, live at the NASDAQ. Let's get a quick check on the market action about 2 hours into the trading day. And you're still seeing green across the screen as investors continue to digest ongoing trade headlines, with the Dow is up around 100 points. NASDAQ leading the way higher, up roughly 0.6%. And the S&P is following there at 0.3%. Now, this comes as we saw strong earnings results from TSMC, really leading to broader optimism when it comes to the AI trade at large. TSMC reporting record third quarter profits, also raised its outlook for the second time this year. And that not only helped lift the broader indexes, but also the overall semi space. I'm taking a look at a heat map of the semiconductor stocks here. And you're going to see NVIDIA up 1.3%, Broadcom up nearly 2%, Micron up 7%. Now, TSMC is off a bit right now in trading. We did see shares open higher, and now we've sort of been oscillating between the lower end of the flat line. We briefly spiked here, and now we're down roughly 0.7%. So we'll see if we can reverse some of those losses. I also want to take a look at shares of United, the company reporting earnings. We are down again. We briefly were up slightly as the earnings call was underway. And I want to just read a few headlines that we were getting from CEO Scott Kirby. He said that United's investments from seatback screens to lie flat seats and fast free Starlink Wi-Fi by 2027 are paying off, driving both premium and loyalty revenue higher. The company does expect to hire more pilots and flight attendants by 2026, even as it trims a management headcount, with the goal to move away from what Kirby called a commodity-oriented business and into a more premium experience. When it comes to what drove the upswing, the brief upswing, I should say, in the share price, it seems like that was around commentary surrounding stronger margins and growing customer loyalty. Scott Kirby also said that a lot of competitors struggled over the summer months. So perhaps there's going to be more optimism ahead as we head into 2026. But right now, shares are down around 3.6%. We'll keep it right here in Yahoo Finance. We'll be tracking all the market moves throughout the trading session.
The nation's average price of gasoline fallen to nearly $3. That's the lowest level in months. It's expected to decline even further. Joining me now, Patrick DeHaan, GasBuddy head of petroleum analysis, or as I like to think of you, Patrick, the gasoline whisperer when it comes to pricing here. We always like to catch up with you about this. So why have we seen prices fall so much? Is it sort of normal seasonality, or is there something else going on?
Certainly a lot of seasonality. Americans simply not driving as much as temperatures start to cool off. We've also seen the transition to cheaper winter gasoline in 49 of the nation's 50 states. In addition, the price of oil falling below $60 a barrel for the first time since 2021. That really having to do with potential trade war or tensions between the U.S. and China. So all of that seasonality now enhanced by decline in oil prices, and also OPEC continuing to raise oil production, giving a certainly a very healthy dose of falling gas prices. In fact, some areas of Oklahoma now just 10 cents away from seeing the first station below that $2 a gallon mark. We certainly expect the $3 a gallon mark will be broken here in the next few days.
Wow, below $2. Amazing. Okay, so we're going to go sub 3. How long do these cycles normally last? How long could prices nationwide, the average price, be below $3 a gallon?
Yeah, Julie, this is something that will probably stick around for a good portion of the winter. Now, if it's a normal year, gas prices tend to bottom out between Thanksgiving and Christmas. So that may give us another 2 to 4 weeks of declining prices before prices then will start stabilizing at some of those lows until maybe January, February. And that's when gas prices start to tend going up. So they should be around these low prices through the holidays.
What about this sort of the latest headlines with President Trump talking about India no longer buying oil from Russia, that having some effect on the market? You know, whether it's that or some of the other geopolitical events, are there a lot of upside risks to oil prices?
I mean, there's certainly upside risks. You mentioned India, another one, China, right? President Trump has been trying to persuade both of them from not buying Russian crude oil. And that's been the imperative part of this market, is that Russian oil, as long as it makes it into the market, that additional supply that Russia exports is helping to keep prices low. So if something were to change there, if India were to stop buying Russian oil, that simply means that Russian oil is not going to have a place in the market. That supply loss then could contribute to higher oil prices.
And what about regional differences around the country, Patrick, that I know you track closely also?
Yeah, Julie, I mean, you had that map up there. Wide disparity in prices. California is still $4.65 a gallon. And on the other side, you know, station in Oklahoma down to $2.09 a gallon this morning. So a lot of regionality, and motorists in those states, I mean, we're talking about less than 2,000 miles with a $2 a gallon difference. California continuing to have the nation's highest gas taxes. They have CARB mandates, rules and regulations keep prices much higher in California. So, you know, it always pays to shop around. Certainly smart motorists in the Gulf, apps like GasBuddy, Google Maps always can show you those huge price differences.
Hey, Patrick, I can't help but notice you are not in your usual studio where we talk to you, I'm told, are at the National Association of Convenience Stores annual show. I'm curious what you're hearing there, because like these lower gas prices, they're great for all of us. I wonder if those convenience store owners are quite as happy about them.
Oh, they love falling gas prices as much as consumers. In fact, stations love falling prices. They really hate when prices go up. That rising prices, when they do happen, puts pressure on margins. So, you know, this is the time of year I think everyone's got a smile, from C-store operators to motorists. Pretty much everyone's excited about lower gas prices.
And I guess if you see the lower gas price and you're buying more gas, you're more likely to pop into the store and buy something.
Exactly right.
Also, Patrick, great to see you. Thanks for joining us.
Thanks, Julie.
We got much more markets action coming up. You're watching Market Catalyst. Stay tuned.
So let's dig right into it. You just announced, Mo, you raised $50 million for this new venture fund. It's going to focus on crypto companies. Now, there are a few such firms like this. What's going to make you all different, Mo?
First of all, thank you again for having me on the show. When we look at crypto today relative to where it was 10 years ago, you know, it's a multi-trillion-dollar asset class. You're seeing large institutions starting to build, and you're seeing regulation kind of be a proxy for giving comfort to these companies. When that happens, you're going to see new companies being born. And so these new crypto companies that are out there need investors that understand how to operate and build for scale. Working at places like BlackRock or BCG, along with my partners that have co-founded the fund, we felt that a $50 million fund was a perfect opportunity to bring operator-led capital to help these next generation of founders entering the space. So we're excited about Maximum Frequency Ventures.
Now, Mo, are you guys all saying, listen, a few more details, who you raised the money from, limited partners, what kind of details?
Yeah, we haven't shared the LP list, but we have great family offices both here in the US, along with East Asia and Southeast Asia, that have joined us in this journey, and they're all sort of excited about this next wave of founders that are coming into the space.
And have you deployed any of this money yet, Mo?
We did. So we've been working on this for a little bit, and we've found 6 amazing founders that we've already invested in, companies that are building new forms of money, folks like stablecoin issuers that are regulated and issuing out of UAE, for example, or Singapore jurisdictions. And then we have companies that are thinking about the new form of IP management and how someone can actually get paid for sharing IP in a more open way versus the closed walls that have existed. So crypto provides all these new paradigm shifts for these different industries, whether it's money or IP, and we're investing in these founders and have made 6 investments already.
Those 6 investments, are those US based? Are they international?
Great question. So 2 of our partners are based in Asia. One is in Singapore, the other splits time between Korea and Hong Kong. Myself and my partner Neil are here in the US. And when we look at founders, we see founders coming from all over the world, to your point. And so 3 of those investments are actually based out of Asia. Singapore, UAE, as I mentioned, and South Korea. The other founders are right here in the United States. So 1 on the West Coast and 2 here based out of the East Coast.
How do you decide, Jeff, who to write checks to? I was once talking to Jeff Lewis. That's another smart tech investor. And Jeff once told me, how in real estate it's location. Yeah. He said, really, it's just founder. Is it that simple?
Man, I couldn't agree more with Jeff. I mean, and I think you said it really well. When you think about who is really behind a company and the company's vision, its strategy, it really ends up being founder driven. And you see that in some of the public companies that are founder led today, all the way to some of the companies that are growing into being publicly listed tomorrow. And when we see these founders, they need that help. And so they have something special in them. We think from our perspective, we can coach them to get to where they need to be. And so there's something special in a founder, but it takes a lot of the operational excellence that we bring to the table to really get them to that, to catapult them to that next level. So we focus on the founders. We focus on what they know specifically about a problem set in an industry, and we bring our crypto expertise and our operational expertise to help them launch.
Given, you have this international kind of scope and vision, Mo, so I'm curious, when you look around the world, what's the country, what's the region that sort of, in your opinion, is leading in crypto in terms of creativity, innovation, dynamism? Is it the U.S. or no? You'd give the gold someplace else?
Yeah, I mean, we spend a lot of time with folks like A16Z and someone like Ben Horowitz who talk about American dynamism. And for crypto specifically, historically over the last 5 years, we've seen a lot of founders building in places like Singapore and UAE because it was unclear in terms of how the U.S. was really setting up. Today, with things like the Genius Act being passed, actually I think innovation is starting to lead here again in the U.S. It's spent some time over the last 9 months catching up, and we think it's going to accelerate from here. A lot of that sort of stalling that took place was because regulation was not clear here in the U.S. So now that we have things like the Genius Act again as in place, I think that innovation and that creativity that sits here within the United States is sort of unmatched globally. With that being said, founders today are global. And so this is why we're taking a both East and West approach. Founders in the West know they have a unique access and opportunity to tap into Eastern markets. Vice versa. Founders that typically might come out of a certain place in Asia may not typically get access to the Western markets. We see this and we see this crossover across borders, no pun intended, with all these amazing companies and founders today, and we think crypto is going to be a beneficiary as a part of this.
Quickly, last question, Mo. You launched this fund as cryptocurrency has been sliding a bit here, Bitcoin, Ethereum. Just quickly, is that, in your opinion, macro worries? Is it just folks booking profit? What do you think?
Yeah, I mean, it's an excellent point to look at the macro. The macro is obviously dependent on so many different factors that are out of the control for crypto. But historically, what we've seen is crypto being a little bit of a multiplier effect on what happens within macro. We saw some of that sort of play out last Friday, as you probably saw Bitcoin take a hit and other altcoins take a hit as well. There are other systematic components that sit underneath that drive some of this in addition to the macro factors. But we don't look at the macro. We look at what innovation is really fueling. And if you kind of think about where technology is sort of headed within the space, along with all the incumbents and new entrants that are coming in, especially with things like stable coins and new world of payments, we think there's so much more to build as part of this stack. And Maximum Frequency Ventures is really well positioned to support that.
Mo, great to have you today, and congrats again on the new fund.
Thank you so much. It's a pleasure.
Bitcoin broke out to a new high of 125,000 and change in early October, and it quickly fell back into its old trading range. But guess what? October is historically one of the best months for Bitcoin, so on today's Stocks in Translation, we are taking a look at Bitcoin seasonality and the next potential catalyst for the king of crypto. And just a quick reminder that seasonality refers to those recurring patterns that we typically see year after year. And in this first chart, we're taking a look at each month of the year broken down, and it's 2018 to 2024. Why did we start at 2018? Because that's when we got Bitcoin futures, and that's when Wall Street started taking notice of Bitcoin. If you go back further, you really have a different animal on your hands. But what stands out here is a few really positive months. So that's 18% in July, 11% median in February, and in October, also an 11% median. And I'm using the median instead of the average because that's right in the middle. If I use the average, you tend to get bigger numbers to the top side and then bigger numbers to the downside in the negative realms. But what you're going to notice here too is that after October, November and December, they skew negative. So unlike stocks where you typically get that end of the year rally basically from October through December 31st, not necessarily so in Bitcoin. However, we do have this positive catalyst right ahead of us. And here's another look at the month-by-month breakdown with win percentage. And what really stands out here is October is 86% positive going back to 2018. And that ties February over here, which was also a good month. And it's a bit bigger than July, which was the best month. So odds are working in the bulls' favor here. And one more thing is that if you break it down on a day-by-day basis, I have the entire year here from January 1st to December 31st, and in white is what the map is telling us. That's, again, the median from 2018 to 2024, and the green 2025 year-to-date. We are right now at the period of time when it historically inflects up. And so the middle of October into the first week of November is a very seasonally bullish time of year. And you can see how some of the swings that we've had in this year, and there was some interruptions, albeit with the post-Liberation Day sell-off, a lot of the recent swings have kind of coincided with the map. So things are definitely working in the bulls' favor right now. We'll have to see what comes of that. And let's take a look at what to watch now, because Bitcoin investors should be paying attention to a number of things. First, we have bank custody of Bitcoin and crypto assets that's starting to roll out right now. The SEC gave the green light on that way back in January, but banks have lots of regulators. They tend to move slowly. So many investment advisors have been waiting for the safety of bank custody, so watch out for these press releases from some of the biggest players. Then, number two, the ghost of Mt. Gox still haunting the blockchain. Way back in 2014, the world's largest crypto exchange failed spectacularly, and most of the confiscated coins has been distributed back to the owners, but we're finally up against a hard deadline on Halloween, October 31st. How fitting. There's a small chance that some whales could emerge and dump their new holdings after getting repaid, but that's just a small risk. Then, in the spring of 26, the IRS is rolling out new tax forms to report crypto sales. It's going to be a little bit more of a burden for crypto traders, and there could be a few jitters around tax day, but it's still a pretty small risk. You do have to watch ETF flows because something is definitely going on there. Spot crypto funds have raked in $40 billion so far this year, and any let-up in flows could signal lower crypto demand, which impacts price. And finally, watch the current trading range in Bitcoin, which has been in place since July from roughly 108,000 to the downside to 125,000 to the upside. And remember, Bitcoin is famous for its rug pulls and false breakouts, both to the upside and also to the downside. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
Healthcare startup Counsel Health completed a Series A funding round of $25 million led by Andreessen Horowitz and GV to launch its AI healthcare platform. The company making a bid to improve healthcare accessibility by using artificial intelligence. Joining me with more, Dr. Muthu Alagappan, Counsel Health founder and CEO. Thank you so much for being here. I think, there is a lot of talk about a marriage between AI and healthcare recently. How do we bring them together and improve, and do the ideal, sort of improve the standard of care, cut costs, et cetera? How are you guys trying to do it at Counsel?
Well, first of all, thanks for having me on. Really excited to be here. AI in healthcare has so much potential. And I think in the first couple of years after large language models burst onto the scene, a lot of the focus was on using AI to improve the administrative tasks in healthcare, like writing notes and submitting prior authorizations. But it feels like now a lot of attention is turning to the clinical side of AI. Can we teach AI to work alongside doctors to provide high quality care and augment the clinical capacity in the world today? The way we do that is we pair a medical AI that we help tune and train alongside an in-house group of doctors. And they essentially work together the way a medical student and an attending physician would work together in order to deliver virtual care to our patients. And we find that by pairing these two entities together and getting that interplay just right, we're able to not only increase the efficiency and access to care dramatically, but we can do it at far lower costs than we've ever been able to before.
Now, as you are, of course, aware, a lot of people are already using things like ChatGPT for medical advice, right? They're asking it questions. I know anecdotally of certainly many examples of this. So how do you convince people to pay for something like you're describing when they're doing it via one of their apps that they have already?
The great thing ChatGPT has done is it's made it so convenient and easy to access medical advice by just typing a message and engaging in a chat. Where we find that falls short is when you need to go from advice to actually care. Let's say you know now that you have conjunctivitis. Maybe a chatbot has helped you get to that diagnosis, but now you actually need a prescription for antibiotics. Or maybe you have an MRI report and you want a second opinion, and the AI can get you partly there, but you really want a real doctor to diagnose and confirm. That's where that translation from information to actually getting care is where we think the realm of human doctors is really important. And so on Counsel's platform, our medical AI is also free to use. Users don't pay anything to access a personalized medical AI that is giving them information and advice personalized to them. And users only pay if they want to add a real doctor to the conversation. Again, when that advice now needs to transcend into care, whether that be a refill, a prescription, a diagnosis confirmation, a new lab test, any of those things that really only a physician can do. And I think what we've been excited about is co-locating those two entities. So instead of going to ChatGPT and then having to schedule an appointment at your local health system, now you can have one of our doctors enter that same exact chat and have both of that happen in the same place.
And who is this for? Who is this aimed at? Is it aimed at people who already have, say, health insurance through their employer, or is this aimed at people who don't have coverage or have a lower level of coverage and they want this kind of a service?
What we find is that everyone throughout their life has so many instances of needing medical advice, and whether you're insured or underinsured or uninsured, we find that access to care is one of the biggest problems in the industry today. 100 million people don't have access to a dedicated doctor, and wait times to see your PCP, even if you have one, are more than 30 days in most major metros. And so for Counsel users, that ranges from people who have a PCP but just can't get in to see them often enough, to people who are underinsured or uninsured and want a lower cost, more convenient way to access doctors on their own terms.
And I believe you guys have signed up, 100,000 patients thus far?
That's right. Counsel is now available to over 100,000 patients. And starting today, we've actually made Counsel available to the general public in 40 states. So anyone can go to our website, counselhealth.com, and create an account for free and begin using this. But so far, we've treated tens of thousands of patients across a wide range of medical concerns. And we've been able to resolve 96% of those concerns on our platform alone without having to refer them or send them out to an in-person or other health center.
And what's the rate of those folks who needed to sort of level up to an actual physician versus tapping into the AI?
On our platform, we find it's about a 2/3 to 1/3 split. So about 2/3 of our patients' conversations are AI only and actually never require one of our doctors to enter the chat. So that may be checking on the right dosing of Advil for a headache, or asking, when their last tetanus vaccine was. Those types of factual lookups we can do with AI only. And then about 1/3 of our threads escalate to one of our doctors joining the conversation and helping provide the care in that last mile.
And then finally, just bigger picture, what kind of capacity or potential do you think AI has ultimately to bring down costs across the health system?
We fundamentally think clinical AI, as it gets more advanced, has the potential to shatter the rising cost trends we face today. And it can do that in a number of ways. One is AI can make doctors more efficient and higher quality in a way that allows us to scale clinical capacity. So an in-person doctor may only be able to see 3 or 4 patients per hour. But through these AI augmented care models, you can see 15, 20, or 25 patients an hour. And imagine how many more patients can be seen in that type of a construct at a lower cost. We also find that these AI care models are fundamentally better at utilizing the scarce resources we have. So when we do send a patient to get surgery or to the emergency room, those decisions are often made with a better sense of where the high value is and how to avoid unnecessary downstream care. We're finding that we're saving employers on the order of $400 per member per year simply from reorchestrating care away from unnecessary sites and more towards appropriate sites of care. And so from both the triage perspective and the fundamental cost nature perspective, we find that AI-enabled care models, I think, will make a big difference to one of the biggest problems in the industry, which is rising costs.
Thanks so much for being here. Really appreciate it.
Thanks so much. Thanks for having me on.
That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.